Your money will always be your biggest bottleneck if you're serious about achieving financial freedom through real estate. Let me very simply break that down. You more than likely will never be able to earn or save enough money to buy real estate investments quick enough to achieve financial freedom on a timeline that you prefer, right? And I'll give you plenty of personal examples of how I've been able to scale my real estate portfolio to over $25 million of real estate in less than 5 years. The key thing there is it cost me $6 million entry cost to acquire it, renovate it, furnish it, reserves for the properties so that I could own this $25 million portfolio that generates tons of cash flow for me. Even if your goal was, let's say $10,000 a month of cash flow, $5,000 a month of cash flow, you would still need a few $1,000,000 of real estate. And if you're buying real estate traditionally using traditional financing, 25% down payments, you'd still need at least a couple $1,000,000 of real estate. So you're still going to need several $100,000. Let's say you're trying to build a $2 million portfolio, which is on the lower end of what you need for financial freedom. 25% of that just to acquire it is $500,000. Maybe another several $100,000 is what you'll need to renovate and furnish it and have reserves for the property, because you have way more entry costs than just the down payment. My example basically of how I decided very early on that if I had to rely on my own money, I would be stuck just like almost everyone else is. So the best thing I could do is learn the right skill set to be able to buy more real estate more quickly so I could be financially free in a shorter time frame. As I mentioned, I bought over $25 million of real estate. Well, that cost me around $6 million to buy it, renovate it, furnish it, and have reserves. Well, I've never even made $150,000 a year when I used to work a job. But let's say I did earn $150,000 a year. It would have taken me 40 years of earnings to have had that $6 million needed to build my current portfolio that I was able to do in 5 years. And understand what I just said, 40 years of earnings. That's not even savings. If I'm lucky, maybe we're saving what? $10,000, $20,000, $30,000 at the most. Even if you're making $150,000, most people are not saving thousands, if not tens of thousands of dollars. Even with my example of $150,000 earnings going 100% to savings, going 100% to investing, it would have taken me 40 full years to have earned enough to have bought my portfolio. And that's obviously way exaggerated because it would have taken way longer because I would have saved way less than the full amount that I was making. And I never even made that much. So when I was active duty in the military and I was making significantly less than that, I knew that I was not going to be able to save my way to financial freedom. I had to learn the right strategies. And I do want to caveat, right? You, in theory, can save your way to financial freedom. It's just going to take you significantly longer, right? And for me, it's the balance of how do I achieve what I want, financial freedom, control, more money coming in every single month than I'm spending. So then I have total control of my time. But how do I also do it in a more condensed time frame? Because if you want to just earn, save, and invest, you can also do that in the stock market, right? You could just passively invest in the stock market, wait 30, 40 plus years, and then achieve financial freedom that way. Obviously, real estate supercharges that. You can get there faster and have way better overall returns and all the wealth benefits associated with real estate. But that would still take a significant amount of time. So I said, okay, instead of trying to get a ton more active income so I can earn, save, and invest that, why don't I develop the number one skill set that I need to become financially free in a shorter time frame, which is I need deals, but I also need the money to fund those deals. Well, why don't I learn the skill set so I can go and find the money to fund these deals and end up with various win-win scenarios? I just gave you my example, but once again, the harsh reality is that 99% of people will never earn or save enough to build a portfolio big enough for freedom unless you're okay with it taking forever. That was never the thing that I wanted to do. So I decided to invest in myself and invest in developing the right skill sets so that I can achieve everything that I wanted to through more work and more knowledge, right? But less time earning an income. People forget that it's not just that traditional real estate investing takes a long number of years to get there, But to achieve any form of success in that route, that also means not only is it going to take you longer, but you're actively working for someone else for 40 plus hours a week for that whole period of time. So it's not that just more years that's going to take to achieve your goal, but it's also you're working longer for someone else. You're giving away more of your life, not just in the total number of years, but every single year, every single month, every single week, you're working for someone else with a limited lifestyle for that whole period as well. So when it's kind of explained that simply, it seems obvious. Duh, I need to learn how to raise money so I can achieve my results more quickly and more effectively. I gave you my example, right? $25 million portfolio, $6 million to achieve that. Able to do that in 5 years, a lot of it happening in the last 3 years as I develop better skill sets, managing my properties as co-living, rent by the room rentals to maximize all my returns, using creative financing to be able to buy properties for way less money down with way better interest rates, and then raising capital so my money was never a bottleneck, was never a limitation, my ability to buy great investments, right? I'm going to give you some more straightforward examples. I'm going to share a few slides kind of just to help you out if this is something you're interested in learning how to do. Here we go. Funding your entry costs. Your entry costs, right? We're not talking about financing the loan and all that stuff. We're talking about your entry costs. What it's going to cost for you to acquire the property. So any down payments, if there's any liens that need to get paid off, any agent commissions, closing costs, wholesaler fees, whatever. Everything it costs to acquire the deal, to renovate and furnish it to the level in which is necessary for your management strategy. For example, when I'm doing rent by the room, I'm adding more rooms to the house and I'm furnishing it. And then any reserves. You really have 3 options. Either use your own money, which most people don't have enough to even buy one deal, let alone multiple, let alone enough to be financially free. Use other people's money, or you do kind of the combination of both. You use some of your money and some other people's money. This is a more advanced strategy, and you have to understand the way this works when it comes to your deal analysis. This is stuff that I teach super investors. So as a plug real fast, you have over $50,000 of savings right now. Probably the worst thing that you can do is use all that money to go buy one deal. Because once that's out, how long will it take you to get that money again? And honestly, it takes around $100,000 to buy a property with all-in costs. So how long would it take you to have to save your way there? If you have $50,000 or more, I quite literally have showed dozens of investors how to take that same amount of money, invest a piece of it into their education, right? Working with me and super investors. But the end result, instead of maybe having one property and maybe not buying the best type of deal that you could have, they have the right education and knowledge now to go use that same money to go buy 2, 3, 4, 5 investment properties instead that are way better investment properties. And now at that point, they've got 5 properties under their belt that are all really great, generating them solid cash flow, and they've raised money for those deals. Now it's easier and easier at that point to raise more and more and more money for every future deal. The hardest way to raise money is having no experience, no money of your own. Like the more experience and money you have, the easier the journey is. At a certain point, your own money no longer matters. I raise 100% of my funds for all of my deals. So my own money is irrelevant because my experience and my reputation is so strong that I can raise money, 100% of it, without having to put any of my own money. If you have $50,000 or more dollars, you can waste that on one potentially terrible deal or get educated and turn that into multiple deals, build your credibility to raise more capital. And you also have the step-by-step playbook on how to raise capital for every single future deal that you buy. The difference in return on investment is not even comparable. Buying one terrible deal potentially, if you could afford it, to being able to have all the right knowledge, skills, and everything you need, buy multiple properties, build your credibility of ownership and capital raising, and do this as many freaking times as you want. It's not even comparable. So that's why I tell people, if you have $50,000 or more ready to go and you are committed and willing to take action and you're coachable, I can help you achieve your financial freedom freaking instantly. If you have 50K, that's great. Can help you get into at least a deal. You have 100, 200 or more $1,000, like some people I've worked with, we can turn that into basically, instead of maybe buying 1 or 2 deals, that could be enough to build your entire freaking portfolio in the next year or 2 and be fully financially free. If someone tells you that there are no advantages in real estate investing, that's just not true. If you have experience and you have money, that makes it way easier to do real estate. Money is really the biggest cheat code in all of investing in general, let alone real estate investing. Where people go really wrong is they use their own money inappropriately. They use it for buying a single property and playing catch up for the next 5+ years to be able to buy the next one when they could have used that way better, right? So let me show you some examples, just to kind of paint the picture home, because I'm a spreadsheet kind of guy. So this chart right here basically is a projection of achieving financial freedom through real estate investing, right? If I did the stock market route, it'd take 40+ years. I've already done that, right? And the only thing you can control in the stock market route is how much money you're investing and how quickly. The only thing you can do there is make more money and spend less, and that's the only way you could accelerate your journey. The reason why I love real estate is because you can leverage strategies to achieve your goals way faster than you ever could passively investing into the total US stock market, because you have a lot more control of what you buy, how you manage it, how you structure it, when you sell it, everything. So real estate is inherently a massive cheat code, but there's ways that you can do real estate to make it even better for you so you can achieve your end results quicker. And those are the strategies over the savings. My plan was never to save my way to financial freedom. That would just take too long, especially if you are like me and you are not born with a silver spoon. You do not win the lottery. You have to start from basically nothing but what you have built yourself. If you are in that position, you might as well be the best steward of what you've already done and achieve your results more quickly by implementing the right strategies and not shooting yourself in the foot, especially if you have a lot of capital available to be able to invest fairly quickly. So in this example, we're talking about a long-term rental. You buy a house and you rent it out to a single family, a 4-bed, 3-bath, like to a single family. And in this example, every property that you buy like that is going to cost you $60,000. Every property that you buy like that is going to generate you $500 a month of cash flow, which translates to a 10% cash on cash return. Honestly, that's like a gold standard for long-term rental investors. However, most people cannot find that currently because prices have gone up so much and interest rates have gone up so much. However, I'm using this as an exaggerated example to show you, even in this scenario, it would still take you a pretty extensive period of time if you're only buying real estate using your own money. In this instance, I'm saying that every single year you are saving $30,000. Most people cannot save $30,000 in a year, nor are you in the starting place, like I say here, that you start with $60,000, right? I'm already giving you a competitive advantage in this scenario by saying you start with $60,000. Every year you're saving $30,000 and you're getting fairly high cash on cash return. Just to paint the picture home, how the advanced strategies blow this out of the water comparatively, but I wanted to give a fairly decent timeline for you. In this example, you buy your very first property and it generates you that $6,000 of cash flow, or the 10% cash on cash return. You have the $60K, now it's down to zero. Well, year two, by the end of year two, you're generating another $30,000 of savings and you have your $6,000 of cash flow being added in here. So you have $36,000. You cannot buy another property because you don't have $60,000 yet. Well, year three, between the $36,000 from year two plus the new $30,000 and your new $6,000 of cash flow, a lot of numbers, right? After using $60,000 to buy your next property, you have $12,000 left, but now you have two properties generating you $12,000 a month of cash flow, or $12,000 a year of cash flow. Well, year four, once again, you still don't have enough because you have $54,000 to buy your next property. Year five, you had another $30,000 plus this $12,000. After using $60,000 to buy a property, you have $18,000 a yearly cash flow and $36,000 reserves. We continue going down this path every year that you're able to do it. At a certain point, you'll see you're generating so much cash flow per year in addition to your own savings that now, instead of having to wait a year in between, you're able to buy every year. Till year 15, you get to the point where you can start buying two. In this instance, if you are buying as many properties as you possibly can with all of your savings, right, from your job, $30,000 a year, which is crazy for most people, like they cannot do that, and you're saving all of your real estate cash flow and getting way higher returns than most people can in long-term rentals right now, what you're doing here is in 16 years, you have 18 properties generating you around $108,000 of cash flow. That is $9,000 a month of cash flow, tax-free, right? The goal here was just you to $100,000 a year of cash flow a year, because at that point, you're already in the top 20% of income, but you're getting this passively, right? With very few hours of work a week, not having to go show up to a job or whatever. So it's already at a massive advantage And you don't have to pay taxes on this stuff if you are using the right financial people, the right bookkeepers and CPAs. But that's where we get to $100,000, putting you in the top 20% of income earners, and you're doing it tax-free, and you're doing it for 2 to 4 hours a week of actual work. So that scenario would take around 16 years and 18 properties to get there. Well, if you went the same long-term rental route, your cash flow would be the same, and actually it'd be lower because now you're splitting the returns with a partner. The difference is because you're using someone else's money to buy these deals, you're able to buy way more deals way more quickly, right? And I don't go crazy in how quickly you buy deals. It's all very realistic and is nothing compared to my own trajectory. This is way slower than the way that I did it, but I wanted to make it fairly realistic. If you're starting with your very first property or you have a few under your belt, you're not ready to scale and buy 10 plus a year like I've done. In this example, where it's still long-term rental, same returns, but in this example, you are buying the properties by raising money and splitting the returns, right? You're end of year one, you're buying 2 properties. So instead of buying one, you're able to buy 2 properties by raising the money for it. You are splitting ownership with your partner for every deal here, 50-50. So every single deal that you're buying here is a 50-50 split. They bring 100% of the money. You guys split all the returns, all the cash flow, 50-50. So instead of $500 per property, you're getting $250. Well, no surprise here, the annual cash flow year one is the same as year one here because you're buying 2 properties and getting 50% of ownership in each, where in this example, you're buying 1 property and getting 100% of ownership. The difference is that in this instance, you spent $60,000 to get there. In this instance, you raised $120,000 to get there. Does that seem like a lot? Potentially. I've raised millions of dollars. Plenty of people that I've helped even on their first deal have raised hundreds of thousands of dollars, and understand that everything just gets easier over time. So it's harder the first time. It's a little bit easier the next time, a little easier until it's almost super freaking easy because you have all this momentum, experience, knowledge, all of this good stuff working in your favor. Well, you're not going to be surprised to find out you're going to need more properties to achieve financial freedom if you're using other people's money because you're splitting returns. However, you can get there way more quickly. And let's go through this visually. So in this instance, instead of buying 1 property when your money allows for it, you're able to buy 2 properties when your operations can handle it, right? Because it's not enough to find great deals and to raise money to buy those deals. You have to successfully then close on it, renovate it, furnish it, rent it out before you're making any money. That's the case for anything, but that's your biggest limitation once you have the skill set of raising money. How many properties can you safely bring in, renovate, furnish, and rent out so you're making money? How effectively can you do that? That's why we don't just buy 20 plus properties year one, because even if your capital raising skills are great, because there's no point of buying properties if you cannot operate them successfully. Because if you can't, you'll be like a lot of other poor operators who then end up losing everything. Because if you're not generating the cash flow, or you're taking way longer than you're expecting to, you're no longer going to be able to pay your mortgage, which means you're no longer going to continue generating cash flow because you no longer own the house. You're no longer going to get any wealth benefits because you no longer own the property, right? So the operations is your biggest bottleneck, which is a great thing because you can hire for operations in so many different ways. I actually specifically teach super investors how and who I hired every step of my journey and what I recommend they do to accelerate their journey. This is why it's more advanced. We're talking about now hiring people and all that. But if you know this information, it makes your journey way freaking quicker and better because of all my lessons learned. So in this instance, you buy 1 every 6 months, 2 properties a year, 1 every 6 months. Same cash flow year one because it's 50% ownership of 2 properties instead of 100% ownership on 1 property. Difference for your $60,000 you start with still sits there. So you still have $60,000 where you had to deploy it in the first instance. Year 2, you do the same thing. You buy 1 property every 6 months, 50-50 ownership. Now you have 4 properties and $12,000 a year of cash flow versus year 2 here where it's only $6,000. On top of that, now you have $96,000 sitting in your bank to do whatever the heck you want with it. Lend, invest. It doesn't really matter what you do with it. You have this $96,000 that you wouldn't have had if you were using your own money. Well, year 3, you get more confident. Your operations grow. Instead of buying only 2 properties a year, you're buying 4 properties a year, 1 every 3 months. That is very manageable, very easy if you are putting the appropriate time and effort to make sure everything is successful. And you're hiring the right team members to make sure that's successful as well. And by year 3 as well, not only can you buy more properties because you've got better skills, because you're finding better properties and you have more experience as an operator, you have to give up less to your capital partners to still get the capital raised for the deals, because you are now a higher value operator. If you are providing higher value because you're safer and less risky to a capital partner, typically the exchange for that is they get less returns. There's a kind of a little teeter-totter of risk to reward. Typically, when there's less risk, there's less reward. But a lot of people would prefer less risk and less reward, because a lot of people advertise very high rewards, but those people are super risky and they end up losing everything, right? So people understand the balance of risk to reward. A lot of capital partners who have spent years, if not decades, saving the money, they would rather get slightly lower returns, but ensure that their initial investment is protected and the returns are more than likely to be on target, as opposed to a lot of people who try to raise money by having these really exaggerated or inaccurate or false, like blatantly false return projections, which don't even make actual sense for the deal. So that's why over time, as you become more knowledgeable, more experienced, people understand who you are and you're building a reputation and your credibility, you're able to offer less ownership to your partners and still get deals done. This is how I can raise money and provide my capital partners 20 to 50% instead of always going 50-50 or giving them the majority like some people have to do, right? Because I'm a lower risk investment to partner with me than someone who's newer or with less experience. So in this instance, year 3, you increase your operations. You can buy one every 3 months now instead of every 6 months, and you're keeping slightly higher percent of ownership, and which means you're keeping slightly more cash flow per property for all new investments. By the end of year 3, you have 8 properties versus the 2 that you would have had by end of year 3. That means instead of $12,000 of cash flow, you have $26,400 of cash flow, even though you've given up 50% of all this and 40% of the ones here to your account partners. You're not really giving up, right? You're exchanging value. You're providing them a great investment opportunity to partner with you, and they're providing the capital to get the deals done. So it's a win-win mutual exchange of value. Your value is deals and operating those deals. Their value, providing the money to get those deals funded. So you have 8 properties instead of 2, way more cash flow than you would have otherwise. More importantly, you have $138,000 you've saved over these 3 years through your own personal income and cash flow, right? In addition to way more cash flow that you're generating here, you've also saved a significant amount more of capital because you're not using your money to buy the deals. This is an extra $138,000 sitting in your bank account to be used for whatever you want. This is one of the big cheat codes. It's not just the raising the capital to get more properties that generate you more cash flow. You're also not using your own money, which can be used for literally anything else. Doesn't matter what you use it for. If you invest it, even better. Understand that to get these 8 properties, you've had to raise $480,000. Right now, today, telling you to do that might seem impossible. It might be like, how would I ever do that? I can't even raise $10,000. Well, that's the thing. By this point, you've built your skill set. You've already started with some money. You can actually get this done way faster with way less money because you're combining it with your own. But it might seem like a huge number now, but in a week, I just personally raised over $700,000 to go buy 5 more investments in a short period of time, which will be getting done within like a quarter. We'll get all those investments operational and successful for our partners. In the last 8 months, I've already raised millions of dollars, right? So saying $480,000 in 3 years is not that crazy, right? Although it might start slower initially and it might take you even longer to get your first deal raising money entirely from other people, understand that it gets faster and faster and easier over time. That's one of the best compounding benefits of real estate investing. Year 4, you're still buying 4 properties, still 60%. Now you have 12 properties generating you $40,000, almost $41,000 of annual cash flow versus $12,000. You've got $194,000 you have not had to touch that's sitting in your reserves from your cash flow and your $30,000 a year from your job, extra savings. Year 5, you're even less risky to capital partners. So now you're able to offer 30% to your partners. You keep 70%. You're still only buying 1 a quarter, right? For a year. Now you're at $57,000 instead of $18,000. You've raised almost $1 million in 5 years, understanding that I've raised over $6 million, even more than that as of the last couple months. It's not that crazy if you develop the right skill sets and you do it early on at the right time. And on top of that, you've saved $250,000 that you would have used in this instance to buy these couple properties between cash flow and your job savings. Year 7, right? We jump from 6 to 7. The only difference is in year 7, you finally start buying 6 properties a year, which is 1 every 2 months. I don't expect you to do more than that ever. I've done multiple properties in a single month. I don't expect that for this projection. In this instance, by year 7, by the end of that, you've got 28 properties generating you $108,000 instead of 18 properties generating you $108,000. The biggest difference here is it took you 6 years instead of 18. And by the time 6 years was done, you have almost $500,000 that you would have had to have used. It took you $1.68 million to build this portfolio in 7 years. But there's $465,000 that you were saving from your job and your cash flow that you could have done anything else with, which could have even further accelerated this journey to be way faster. Because that's a thing that I sometimes do. Sometimes I will leverage my own reserves for investing. The clear thing to understand is using other people's money, you're going to have to give up some ownership or give some of your cash flow to your partners. The main massive benefit is your money is no longer on bottleneck. You can get everything done much more quickly. Your only real bottleneck is your operations. And here I'm saying one every 2 months at the highest end that you build to. In 7 years, can you build the skill sets to do one every 2 months? Well, you freaking better be able to, because I did. I did starting less than 5 years ago to now buying multiple properties a month. You can definitely do one every 2 months by 7 years in your journey, where I've done all this in less than 5. I say what I did, not because you need to do what I did, but so you understand what is an example of what is possible for you, especially if you are like me, where you start off with freaking nothing and didn't have a huge salary either being in the military, right? Even if you weren't in the military, most people are not making a huge salary, so they cannot save their way to achieve their results fast enough. Understand, using other people's money got you to your end goal way freaking faster, kept this $500,000 that you could basically use for whatever you want. And at this point, you can continue doing your thing. Even though I achieved financial freedom through real estate a while ago, I still continue to buy real estate because why wouldn't I? I've got all the skills. I've got all the knowledge. I'm getting phenomenal deals, phenomenal properties. I have all the money I need to be able to buy as many as I want. I've developed the team to scale effectively. Like, why would you stop if you had that skill set? But if you choose to, and you want to move on with your life and not worry about buying more real estate, great. You have the freedom to do so, because managing this will take you 2 to 4 hours a week, maybe 10 hours a month, the time it's all said and done. What tends to take a lot more of your time with real estate investing over the long term is buying more assets, renovating more assets, onboarding new properties. Once it's stabilized, it does not take a lot of time. The extra time for real estate is primarily when you're acquiring more deals, right? Finding, analyzing, raising money, doing all your due diligence, closing, renovating, furnishing, setting up your listings, getting all your new tenants, and then stabilizing your management. Once a manager and your financial team is in place, the majority of it is you just checking in, making sure things look good. That's all you have to do once your assets are stabilized. Well, the biggest cheat code now, capital raising, it'd be a disservice if I didn't talk about co-living, the rent by the room strategy, as opposed to just a long-term rental, because I am primarily a co-living investor, because I get substantially higher cash flow and higher cash on cash return for my investments. The higher my cash on cash return means every dollar that we're investing is getting us a higher return back, right? Our money is working harder for us if our cash on cash return is higher. Even if it's my partner's capital, that means we all benefit from everyone getting higher returns, getting our goals faster. In this instance, when you're getting a higher return per property, understand that instead of $60,000 to buy a property, it's going to take you $100,000 because you're going to have to renovate, furnish, and have extra reserves for the property, roughly $40,000 more, because the majority of costs for real estate is just the acquisition, the buying of it. Renovating and furnishing it is not usually the majority of the costs, even for the rent by the room strategy, if you do it the way that I teach people to do it. So in this instance, you're still going on the same timelines, the number of deals that you're buying, right? The same ownership percentage. The only difference is you're putting in more money to buy a deal, right? So instead of 60,000, it's 100,000, and you're getting a 15% cash on cash return instead of a 10% for long-term rentals. What that translates to is, because it costs you more and you're getting a higher cash on cash return, your cash flow per property is $625, your portion of it. The $1,300 it would have taken, like, roughly to get there. So same properties and all that, just your cash flow per deal is way higher, right? Your entry costs are higher. So instead of $120,000, you needed $200,000 instead of $120,000 to buy these 2 co-living rentals, but your reserves and all that other stuff is the same. The only thing that's going to build faster is the more cash flow you get, that's more you get to save, and you get more cash flow so you can get to your end goal more quickly with less properties. So going through the same exact thing we talked about here with the caveat that you're generating more cash flow per property and you need to raise slightly more money to buy each property. In the beginning, buying one property every 6 months. By the time year 4 is done, you bought one property every 3 months. Very doable. You still have only gotten 60% of the ownership percentage as opposed to 70% or higher, which you can get way faster, which is way more likely for you to get once you've got a couple of these properties under your belt. By the time you have 12 properties at the end of 4 years, you've needed $1.2 million to buy that. This is a pretty typical scenario. You're going to need roughly 12 properties. Portfolios probably be worth somewhere around $5-6 million. Let's say $4 to $6 million. It's going to take you around $1.2 million to get that. Well, how can most people do that? Where are they going to get $1.2 million in the next 4 years? You can't. It's freaking your skill set is the important feature here. You need to have the skill set to raise money. Here's exactly why, with a chart that I created with very fair assumptions based off my experience and others, where you probably will never see something like this broken down, this specific, then I can't imagine anywhere else that offers something like this. I share this with you guys because I genuinely care about your success to financial freedom through real estate. Whether we work together and I help you actually accomplish this through super investors, or you just take advantage of all the free stuff and all this value that I provide for free, I want you to be successful. This is one of the ways that I do it, showing you the difference and why it's so important to learn how to raise money and then manage them using CoLiving. You get to your goals way faster, way less money, especially way less of your own money. So the big difference, buying using other people's money instead of your own money allows you to get there way faster. It's going to take more properties, but you get there way faster. It's not even that many more properties. Yes, in this instance, 10 more properties, but you get it done in less than half the time. And you got to keep $500,000 of your money for yourself to do whatever you want with. Secondarily, if you make it even better through CoLiving, so you're getting higher returns per property, not only do higher returns make it easier to raise money, but that means you keep more cash flow. You're able to once again, even buying the same number of properties a year, once again, get there way faster. And this time, way less properties. The combination of CoLiving and other people's money gets you there way faster than you ever could on your own, and way faster than you could using a long-term strategy. On top of that, I do a lot of creative financing. So these numbers aren't even fairly accurate because I get this way faster, right? Because I'm buying properties with even lower down payments, with even better interest rates, meaning my entry cost to buy a deal is less. My cash on cash return is higher. My cash flow is higher, which at the grand scheme of things means I need less money to build my portfolio so I can do it more quickly. And I get to get way higher returns for every single deal, which means I get to my goal quickly. All those are favoring my ability to be able to scale the way that I have. This is why I've been able to buy 70 plus properties in less than 5 years, learn the majority of this independently on my own. Even with mentorship and all this other stuff, I had to still take the pieces I was being taught, put it all together, and then develop a system to let me get there as fast as possible. I can never say I've learned creative financing from my favorite mentor, Pace Morby, but I had to combine everything I've learned from all ways: creative, capital raising, the way that we do super deal analysis, CoLiving, all that, to create that myself and create this super investor cheat code to get my end results faster. I think if you asked anyone, there's always one person. If you asked anyone, the overall goal is to achieve your financial freedom goals, ideally as quickly as possible. If you know you could achieve your goal over 40 years or 5 years, I'm almost certain everyone would want $100,000 or more coming in every single year passively as quickly as possible. You don't want it to take longer. Well, that's how every single phase of this was constructed, to get you more returns more quickly and minimize your biggest bottleneck being your own money by raising other people's money. And it's not just, hey, I'm asking people to give me money. No, what you are doing is you're providing them value. And I'll talk about that. The two biggest skill sets you need, one of them is capital raising. However, you also need the skill set of being able to find and create great investments. You can have capital raised, but if you're not providing them great investment opportunities that make sense, you're either setting them up for failure, both of you guys up for failure, or no one's funding your deals, because even if they say they're interested, you're not providing them deals that make sense for them. One small thing I want to show you visually is there's a wealth building component. All we're talking about here is cash flow and financial freedom. Well, the more properties you can buy, the more wealth you are building in your real estate. The bigger your portfolio, the more debt you have and the more debt your tenants are paying down for you. The bigger your portfolio, the more appreciation you have, the more your properties are increasing in value collectively as a portfolio. And I don't even account here is all the tax benefits. The benefit with real estate compared to any other strategy is I'm not paying taxes on any of this freaking income, where every other, if I'm doing stocks, if I'm doing cryptocurrencies, Bitcoin, whatever, if I'm making money from my job, all that is at a much higher tax rate. I mean, it's not even comparable because it's 0% taxes or extremely low taxes, if not 0%, versus 15, 30 plus percent tax bracket. So the same $100,000 you make in your job, it ends up becoming $70,000 after taxes. Real estate, $100,000 is $100,000 you get to do whatever you want with. So the wealth building. This is an example, just kind of visualizing, right? I'm not comparing any strategies. I'm just saying the more properties you buy per year, the more wealth that you're building. In this instance, we're just buying one property a year. If you buy one property a year for the next 10 years, which is a very admirable and noble goal, even one property, one investment property alone will put you at a massive advantage compared to the majority of people ever in the financial space. But buying one a year, which is not absurd for an actual real estate investor, that adds massive value to you. By the time 10 years is done, your portfolio is valued at almost $5 million with 10 properties. You've paid down $82,000 of debt this 1 year alone. You've appreciated your portfolio $192,000 in this year 10 alone. This 1 year, you've added $275,000 of equity, right? Added to your net worth. You are $275,000 richer in your net worth, more equity based on your property values going up and your debt payments going down in this 1 year alone. Well, your portfolio equity over this period is almost $1.5 million. When they talk about every single millionaire basically has real estate, this is what most of them are banking on. Debt paid on appreciation. Well, as a real estate investor who doesn't have as much money as probably already established multimillionaires, you need cash flow to be financially free. Well, if you didn't, you just focus on this benefit. If you're a great real estate investor, the way that I teach and do it, you're getting all of this benefit, cash flow, living financially free, doing whatever you want with your life without having to exchange your time anymore. And you're building wealth with these great assets. This is even better if you're buying properties, leveraging creative financing, like without a doubt. If you're using other people's money, you're also able to buy more properties more quickly. And you're doing co-living, you're buying bigger, better properties in better areas they do have larger property values, which means you get more appreciation and more debt pay down. So all this is even further accelerated. If you just went ahead and bought 2 properties a year for 10 years, like your portfolio is worth almost $10 million at this point, 20 properties worth almost $10 million. This 1 year alone, you're adding $550,000 of equity, and your portfolio equity is almost $3 million. The biggest thing to understand about this is you don't actually have to continue buying real estate. If you choose to stop buying real estate at any point, this still happens every single year, and it actually only gets better every single year. Your appreciation is faster. Your debt pay down is faster. All of that is improved with time in real estate. I don't even visualize that. I'm a very conservative. I don't try to go too aggressive with my modeling and forecasting, the way I analyze data over time, because I want you to understand kind of the standard or slow scenario and how tremendous that already is. And then it only gets better with everything more advanced, or you do things more quickly or any of that. Because even if you never bought another property, right, you stop buying properties, you're going to get no less than $550,000 of equity out of the next year through appreciation and debt pay down. The next year, another $550,000. You see how freaking insane real estate investing is and how it compounds? This first year is $24,000. I mean, just look at this. And this is every freaking year you're adding this. This is real wealth through real estate. This is your financial freedom through real estate. This is real wealth through real estate. The idea is you're getting all these benefits, ideally using little to none of your own money, which means you're getting infinite returns. We're talking about a $21.5 million portfolio of 40 properties at the end of 10 years. You're adding almost $1,200,000 of equity per year, and you already have an equity of around $6.5 million. Like, that's literally insane. And I hope this visualization is really valuable for you. What I need you to do is I need you to conduct this simple exercise. Drop it in the comments because I need you to really think through this based on your goals. Assuming every single property you want to buy is $100,000, How many properties could you buy today, right now? Right? Not the property's worth $100,000, costs you $100,000 to acquire it, renovate it, furnish it, and have reserves. That is $100,000. How many can you buy today with how much savings you have? If you have $200,000, you can buy two. If you have $100,000, you can buy one. If you have $50,000, you can't buy any right away, right? You need to write this down, drop it in the comments. How much real estate could you buy with how much savings you have, assuming every property generates you $100,000 a month? Next, based on your current savings rate, let's say you're safe. Let's say you only have $50,000 today, which is more than most people, but you have $50,000 today and you're saving a whole $50,000 a year. Insane. Well, year one, you bought no property, but because you saved another $50,000, by year two, now you can buy one property. So how long would it take you based on your current savings rate to have enough to buy the next deal? In this instance, if you had 100 and you're saving 50,000 a year, you buy your first property year one. Well, year two, you can't buy a property, but you've saved 50K. Year three, you have $100,000 now, year two and year three savings that can then be used to buy your next property. So roughly it would take you 2 years saving $50,000 a year to buy your next property. I want you to visualize this so you can see, do you have enough between your current savings and your current savings rate, how much you're saving per year, to achieve your goals in a quick enough time frame? Then sit there and think, if I want $100,000 a year of cash flow, and each property roughly generates me $1,000 a month or $12,000 a year, how quickly can you achieve that goal based on your own money and based on your own savings? You more than likely, just like I had to discover 2 years into my investing journey, was I need to learn how to raise money. I have the skills I need to find great deals, to structure them really well. We can operate them effectively, but I cannot wait several years on my lowly income, even a freaking middle class income. Most people are not saving tens of thousands of dollars. I will not achieve my goals fast enough if it's based on my own savings, right? The less money you're earning, the less you're saving, it takes even longer. The more money you're earning, in theory, the more money you're saving, the more quickly you can get there. Either way, no matter what, I'll tell you right now, your money will still be a bottleneck because most people are not going to save $1.6 million or, however much money it takes to build that portfolio. Lisa, for your example, we're just basing it off this. So how much cash flow does each one do? Well, in this instance, the cash flow is a 15% cash on cash return, which means that's 15% cash on cash return on $100,000, right? That is $15,000 a year of cash flow. What is that per month? That is $1,250 cash flow per month, right? And if you're splitting the money with someone else, right, you don't have to worry about this piece. If you're bringing an account partner in, you're splitting that with them, right? But that's not the exercise. The exercise is you're investing $100,000 per property. How many of those can you fund? Understanding each one of those will generate you $15,000 a year of cash flow, or that is $1,250 a month of cash flow. How many of those can you buy today with your savings? Based on how much you're saving per year, how long will it take you to buy your next one? Once you put this out there and you roadmap out, okay, if I do this, just like I've done, like as a simulation, you got to do your own with a lot of my info. How long would it take you to achieve your goals using your own money? Right? Because for you, you may not save $30,000 a year. And we're talking about co-living, where you're getting way better returns, right? So you may not have $100,000. You may not be saving $30,000 a year. So how long would it take you, based on some of this numbers? $100,000 to buy a deal, $1,250 a monthly cash flow, or $15,000 a year, whatever, right? If your goal is $10,000 a month, which is $120,000 a year, you're going to need $120,000. That divided by $15,000 a year of cash flow is 8 properties. Okay? For every co-living deal that you're buying that costs you $100,000 to enter and is getting you a 15% cash on cash return, you would need to buy 8 total properties to get there. Those 8 properties are going to require you to have $800,000 to achieve that goal. If your goal is to do it in 50 years, maybe you're able to, right? Maybe you can earn and save enough for that. If your goal is to do that in 5 years and you need $800,000, can you earn and save $160,000 every single year to achieve that? This is why it's important to understand this. When I did this as an engineer, right, I realized, holy shit, this is the goal that I want. These are the numbers that I want, but my projection for my timelines is inaccurate unless I have an ability to fund more of my deals using other people's money, right? I need to figure out a way to fund these deals using either less money, which I do with creative financing, and ideally none of my own money so I can buy great deals. That's what this is all about. That's what this exercise is about for you. Let's continue on. So hopefully that exercise was massive for you, because I don't think people even understand this component first and foremost, but I also don't think they really have sat and took time to think about their actual goal. The reason why I've been able to achieve success through real estate investing, in my opinion, in such a quick time frame is because I've been very methodical about it. I knew what my end goal was. I knew how much money I wanted to earn monthly with little to no time after I've set up my portfolio. You just spend time with the acquisition phase, the startup phase of your real estate business, but once they're stabilized, it's significantly less time. My existing portfolio takes virtually no time to manage. But I said, okay, if I want to achieve these goals, how many properties do I need to buy that generate this much cash flow? Okay, well, what can I do to increase my cash flow, increase my returns per deal? Okay, even then, in the best case scenario, how much money would I need? In that example, I said you're going to need $800,000. Well, I knew it would take me freaking forever to achieve that. The reason why I highlight my personal journey of $25 million of real estate with around $6 million put into these deals is because even in the best case scenario, if I made more than I've ever made in any given year and saved all of it, it still would have taken 40 years. If you want an example, there's no better example than that real life one. The next best one is the simulations I just provided you and gave you everything that you need to be able to roadmap your journey there. If you would like me to put together some type of simulation tracker, maybe in the free financial freedom budget tracker that I already provide you for free in my Wealth Through Real Estate School community, it's in my Instagram bio. It's typically below the YouTube descriptions to get in there and take advantage of all those free resources. But if you want me to add some type of simulator to make it even easier and faster for you to simulate this, let me know. I will create that for you and add it in there, but I need to see that it's worth my time to do so. So let me know in the comments, whether you're watching live or the recording. I need to know. And like I said, this is great, right? But if you are someone who has $50, $100, $200,000 or more, deploying all of your capital initially to buy a single property or maybe two would be the worst thing you could do financially for yourself. It'd be great because you can maybe buy a single property, right? Puts you ahead of most people. However, that same amount of money, that $100,000, instead of being one property, now you're stuck saving for the next several years before you can buy your next one, you could have invested in the right education and mentorship and community so that instead of that one deal generating you, let's say, 10% cash on cash returns, $500 a month of cash flow, whatever, you're able to generate way more returns on that deal, both from cash flow and because you're buying bigger, better properties through CoLiving and combine that with creative financing, you're getting better cash flow, getting to your goals faster with less properties. You're also building wealth faster, just the way I showed you the simulations. On top of that, instead of using that to buy one single property, you learn how to take that and be able to buy 2, 3, 4, 5, 6 properties, depending on how much money you have available, which gets you way more cash flow way more quickly. For some people, that's all that they need to be entirely financially free, right? But more importantly, you also have the skill set and now the experience, the knowledge, the portfolio, everything to raise money more quickly, an unlimited amount of times to buy as many properties as you want, which A, means you get to buy more properties because you can raise money faster, or B, you have to give up less because you're a more proven operator. You are less risky, right? This is the biggest cheat code. If you learn the skill sets, you invest in the skill sets, and you have capital, you're at a massive unfair advantage when it comes to real estate investing and achieving your financial freedom goals quickly. I didn't have that benefit. I had to go all in from the very beginning on being an expert in skills so that I can achieve this goal, even though I did not have a lot of money starting out or any given year for my income. The biggest difference, you can use that same money to buy maybe one deal that's going to perform much worse, or be able to buy a lot more properties that generate you more returns per deal and more returns collective because you're buying more assets and you've done the thing multiple times now and raised money for that. So you can do this more easily, like forever and always, however long you want to do it for. That's why I didn't stop investing in real estate when I hit financial freedom the first time, developed even more skills, achieved an even higher level the second time. Why I don't stop? Because it's easy now. It's super easy to do this thing once you got all the momentum, the team and everything. and all the skills under your belt, this is the best compounding benefit of real estate, is you get to learn and get better over time. And the more experience you have, the easier everything gets. To finding more deals, structuring them even better, operating them successfully, and raising the money for those deals, all that gets better with a bigger portfolio and more proven experience. It's really an opportunity cost, right? Like either you are spending it on one, maybe not great investment, or you get an unlimited return on that money through investing in the right education. Obviously, super investors is what I'm referring to. Work with me and our team to help you take that and buy way more properties that are way better deals. And you have the support to know, okay, the analysis is solid. Can someone else verify this? Here's my plan for renovations and furnishings and every single component of it. It's being done easier with less risk and better. Not only get to buy one, that's better. You get to buy significantly more. And then it makes it easier to do everything else. At the end of the day, the skill sets that you truly need to scale your portfolio, like all it takes to buy and hold real estate is two things. You need great deals and you need the money to fund those deals. We've spent all this time talking about the money to buy those deals. It does not have to be your own money. It could be other people's money, right? But at some point you need the money to buy those deals, to enter acquisitions, renovations, furnishings, reserves. You need the money to do that, right? Once again, it does not have to be your own. I hopefully made the case 50 different ways why raising capital is a massive advantage, even though, yes, it's more work, it requires more knowledge and more effort. The returns are insane. When I say more work and more effort, remember, I would rather work and build relationships with people who have capital virtually on my computer from anywhere in the world, anytime that I want, as opposed to having to work for 40 plus years for a job that I probably don't like the majority of people do not like, to earn way less and do this for way longer. Like, it's always an exchange. It's not that it's like, oh, it's more work to do this for real estate investing. Yeah, but that work in real estate investing is better and easier with way better returns than more work per day and for longer at your freaking job, where all you're doing in that instance is helping whoever the CEO is buy another boat or yacht using you as their form of leverage, instead of you learning how to raise money as the best form of leverage when it comes to real estate investing. That's the gist of capital raising until I start talking about the different capital partner types coming up. The only other true skill set that you need, like I said, is the ability to find great deals. You need to know where to find deals and then what makes a great deal, right? How to analyze them and then restructure them to make them even better. If you do not have great deals, it doesn't matter if you're able to raise capital, right? Because you're probably not going to get that capital deployed into your investments. And or if you do, you're probably setting everyone up for failure. Think of it like this. Without great deals, no one wants to partner with you. Some people may say, yeah, we'll do it when the deal is present, but it may not be the right deal, so they'll never actually move forward, even though they gave you a soft commitment that they would. This combo of finding great deals and raising capital is exactly all that you need to be able to buy an unlimited amount of great investments to generate your cash flow and wealth. You still need the operations on the back end to actually perform, to do the renovations, the furnishings, the management, the financial stuff. But you can hire that out to experts and get community support for that through super investors. But to grow your portfolio, you need deals and capital. It doesn't have to be your own capital, and the deals have to be great ones. Very simply, the two types of capital partners that you can have are either private money lenders or private money partners. Private money lenders are people that lend you money that is debt-based. They give you $100,000 and you're giving them a fixed interest rate return. So they're lending you $100,000 to buy this deal for a 12% interest rate return. You're giving them 12% return on their money per year, which translates to $12,000 in that example, or $1,000 a month, right? You're giving them that money. It's secured by the property. It's great for you because you know exactly how much you're paying them every month. It's great for them because if you do not pay them, they get to take over your asset because it's secured by the property. And they will always get the same returns. If they don't, they take your property from you. The difficulty for doing this with buy and hold investing is you have to pay them back the $100,000 when that loan is due. 6 months, 12 months, 24 months later, unless they continue renewing with you, you have to pay that whole $100,000 back in addition to all that cash flow that you provided them. There are those are private money partners where you are co-owning the properties together. You find the deal, they bring the money, you operate it and ensure everything is done successfully. Instead of debt-based, this is equity-based. You are giving them 50% ownership and cash flow for the money they're bringing into the deal, or whatever percent you structure. This is great because they get ownership, cash flow, and long-term upside. A lot of my account partners, if you are someone who's interested in partnering with me, I got a form that makes it really easy, and I try to match the perfect deals for you. If you are raising money, it's very important to understand what type of lenders are you working with, who wants to do what. Private money partnerships are different because they get a percentage of ownership. Their returns can be astronomically higher over the long term, but they're not getting paid a fixed interest rate return. It's not a fixed monthly payment. It's if we do exactly as we projected, here's your returns. We said 50-50, here's your returns on that, 50-50. If the property does better, they get better investment returns, just like you get better investment returns because they get the benefit of the upside. If it does worse, then you all get a worse return than you originally projected. Instead of it being a fixed return, right, like a private money lender, it's, hey, we all benefit from if we do what we said, if we exceed it or we go below, everyone's returns are based on the performance of the property. This is great, even though it takes more involvement. It's great because this works a lot better for longer term partnerships buying and holding real estate. That is why I primarily focus those charts on splitting ownership instead of with a lender, because most people won't have the skill set every year to replace that $100,000 from the last person while you're still raising money for the next one. At the end of the day, I will tell you, once you simulate how much money you will need to generate your real estate portfolio to be financially free, you will very quickly realize you do not have enough money. Even if you saved every single dollar that you could, it would still take you too long. And if you want to achieve your goals in a reasonable time frame, you're going to need to develop the skill set of raising money. As long as you develop the skill set of raising capital and finding great deals, you'll never run out of investment opportunities and the ability to buy those deals. You need to change the mindset from I need more money, I need to save more. Instead, you'll start thinking, I need more skills, I need a better strategy. If you have $50,000 or more and you are serious about being coachable and ready to invest in your ability to achieve financial freedom more quickly, invest in learning the right way. This is exactly what I help super investors do. If that is you, I have an application form underneath here. There's going to be a lot of questions that might filter you out. I want to make sure you're the right fit and I can help you succeed. Otherwise, I will point you to all the free resources I provide, as well as other resources for you. In my opinion, if you have $50,000 or more and you're not investing in this education, you are setting yourself up terribly. The one caveat is if you want to be a partner with me, and for two reasons in particular, you have money, but you don't have time, and you say, hey, I know I need to partner with someone. Great, be my partner. Let's all benefit together. Bring the money. I'll do all the rest. And you get the passive ownership benefits, or you have the money and you want to invest so that you can understand this process, not just from the education perspective, but real hands-on education, actually owning the property together. That's another viable strategy, because if we partner on deals and you're a capital partner, you're going to learn a lot through that process, but you're also going to have ownership that you can leverage for your own real estate investing journey, your own ability to get more deals and raise more money. Ideally, if you have $50,000 or more, we can get all of that done. Get you the right education you need, get you into at least one asset, if not multiple, whether it's as a partial owner, or I can help you just get way more deals way more quickly. Additionally, if you're not in the position in which it makes sense, and you don't have the savings or reserves, you should not apply for super investors unless you have at least $20,000 or more in reserves. I'm just telling you that right now. If you don't have that, focus on taking advantage of all the free stuff that I provide you. Take advantage of my free Wealth Build Real Estate School community. Take advantage of these long form pieces of education, these long form training videos that no one else is going this in depth for. Take advantage of all that, because I want to see you at the position in which you have $20,000 or more, so I can help you scale to real financial freedom through investing in real estate, right? Whether it's your first deal or it's your 10th deal, I can help you accelerate your journey and get there way more quickly through the Super Investor Cheat Code. CoLiving, creative finance, capital raising. All three of those are the cheat code. Some people join for one or two of those. Some people want all of it. My recommendation is all of it, but you can benefit if you're doing midterm rentals phenomenally and you know how to find those deals. Capital raising will take you to the next level. If you are already doing creative financing but you're not doing co-living or capital, like you can mix and match, or all of it all at one time. You will benefit from all of it. Please, let me see where you currently stand. How many deals could you buy, assuming you have to pay $100,000 to buy a deal? How long would it take you to save for your next deal after that based on your savings rate? Will you be able to achieve your financial freedom goals like in a reasonable enough time frame for what you actually want to, and like how much time you want this thing to happen? The Super Investor Cheat Code allows that to happen more quickly with better returns, and your money is not your bottleneck. That's the overall goal. Get more cash flow, get more wealth in a much shorter period of time without your money being a limiting factor. That's the Super Investor Cheat Code. Whether you work with me or not, I don't really care. You have the knowledge there to then go do what you can. Understand the opportunity cost. If you do it yourself, what position could you be in a year from now? Would you be in a better or worse position? I can't tell you that. It depends on who you are and what you're putting in for your skill set.